It's Wednesday and you're watching FreightWaves Now. I'm your host Anthony Smith, and coming up, Luke Falasca is going to give us a broker update. We also have Mike Baudendistel back with us with the Rail Intermodal update, but first we're going to go to Zach Strickland with the carrier update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your Wednesday Carrier Update presented by PowerFleet. I'm Zach Strickland, and today we're going to dive a little bit deeper into the reefer world. So the reefer carriers out there, certainly pay attention today because we're going to talk about all the way throughout the freight market today where reefer activity is hottest and coldest, no pun intended. So reefer volumes, here in the orange line, we can see that reefer volumes are slowly starting to pull back up after they troughed slightly. They were certainly not as impacted as the dry van carriers out there during this whole pandemic thing, but you do see that there was a sharp increase in reefer activity towards the late March, as it declined, into late April, et cetera. And then tender rejection rates there in the blue line did the exact same thing, except a lot sharper dive on the tender rejection rate versus volume. So not a one-to-one relationship by any means. You can see that tender rejection rates actually having a relatively steady climb since the late April dip there, all the way back up to 13.5%. Now, how does that compare year over year? If you draw it all the way back here, we're actually almost right in line with where we were this time last year. So not a lot of year-over-year growth in tender rejection rates, contrary to the dry van side, which has seen significant year-over-year increase in tender rejection rates. So again, reefer rejections about on par with this time last year, not something that we would anticipate. However, reefer volumes here in orange actually higher. And this is again kind of indicative of the fact that we saw a lot of contracts being driven last year on the reefer side, a soft market. Reefer carriers have a lot more spot market presence than they do on the contracted side. So a lot of reefer carriers opting to get into those contracts with a lot of the shippers, and so it increases that reefer volume, especially on the electronic tender side. So again, the reefer carrier been a little bit more resilient. This is the revenue per driver per week reefer carrier up here by the TCA members. You can see that it is on a decline, and it did drop a little bit there in May, but it is a lot more resilient than this dry van counterpart down here. So the dry van carriers seeing a lot sharper decline this year, early part of 2020. We did a FreightWaves Now on this as well, talking about how a lot of those contracts got implemented in January, dropping their revenue and their rates in the early part of the year. Reefer carriers had a little bit of the same thing late last year, but again, not as much as we saw on the dry van counterpart. They got a little bit more leverage in the market, keeping those revenues propped up a little bit more. So again, reefer carriers doing a little bit better on the revenue end. Again, costs a little bit more to pay for those trailers as well. So you're looking at the regional reefer tender rejection index to see which areas are showing the most intense activity in terms of tender rejection rates, et cetera. We can see that the West here, this is the blue line, follow the blue line out here, the West showing significant increase year over year. So look all the way back into August, July last year. We have a lot different market than we did this time last year. Tender rejection rates significantly higher, 22.28% on the West region, including Arizona, California, et cetera. And then the Southwest there in the pink, or the purple, I should say. Again, up over 22%. So the Southwest and West really driving a lot of the volatility in the reefer market, but the rest of the country showing a relative stable, normal pattern. The East Coast, of course, getting the benefit of a lot of that reefer activity going into those markets, so it's keeping it a little bit more stable, but it's leaving a big void out there on the West Coast. So again, out there in the Northeast, 4.5%, hard to get out of there, especially on the spot market, and then the rest of the East Coast showing similar patterns. So 10.5 out there in the Midwest. So here are our biggest cities. Across the United States, you can see the big blue line out there. That's Los Angeles, California, driving a lot of that volatility. So reefer carriers should not have any issue finding any loads on the spot market out in Los Angeles right now. Atlanta, Orlando, Chicago, all down here in the smaller circles. So again, West Coast for spot, East Coast, you're going to have to live on that contract freight. And that'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hi, good morning everyone. I'm Luke Falasca bringing you another broker update. And if you haven't figured it out already, the market is extremely volatile. And with volume levels and tender rejections continuing to rise to new highs, it keeps making our eyes wider and wider. Look at this blue line. That's that volume level. It's continuing to push higher. We've seen it push higher almost every single day this week and even a few days last week, and it doesn't appear to be slowing down. The interesting thing will be what happens after the 4th of July. Does this trend continue, or does that sort of nip it and we start to slip back down into a seasonal pattern? Time will tell. Now that orange line there, keep an eye, that one is really starting to rocket there. Volume levels have been high for a while and continuing to rise, and that's really tightening up capacity. Tender rejections are sitting at 10.29%. That's over a 10% increase from yesterday when we were sitting around a little under 9.5%, give or take. So as that number continues to rise, more spot market rates will go up, as well as routing guides will start to fall apart as networks fall apart on the contracted side. So keep in mind, there's going to be a lot of opportunities here. Real quick, this map here, we're looking at the outbound tender volume volatility map here. So what this does, the brighter the green, those bright green areas, you see bright green and sort of that darker forest green color. The bright green means that that is a very strong increase. This is a weekly increase, a very strong weekly increase, and that's a statistical relevant increase, meaning that those markets don't typically experience an increase quite this rapidly in tender rejections. The forest green is a strong increase, not quite as strong of an increase, but still a strong increase as well, versus the white markets would be unchanged. And notice you don't see any red, meaning there is no real statistical relevant markets tender rejections going down at this time. Some areas do dip slightly, but nothing that's relevant that's showing up here. For the most part, everything's going up, and this is really going to throw a lot of companies' supply chains into whack and a lot of carrier networks into whack. So when you're looking for capacity, it's going to be tight. West Coast here, especially these big markets here in Southern California, as well as some in Arizona and Nevada, very, very tight. Down here in Texas, very tight around Houston, Dallas, Austin, San Antonio, the border. Pretty much all here in sort of the middle part of the country from Kansas, Nebraska, Arkansas, Mississippi, Wyoming, or excuse me, not Wyoming, Missouri, very tight. You do have some sort of like not a lot of change going on up here in the very northern parts of the country, but so far very tight. Keep an eye on these areas here. There's going to be a lot of opportunity to land new customers if you have capacity in those areas. Now we're going to look at the LA market, which is just absolutely skyrocketing right here. This blue line is the outbound tender rejection index out of LA, sitting at almost over 13.5% right now. That's that blue line. We are almost at the year-to-date high here. This blue spike right here was that panic buying surge that we saw, and we have almost surpassed those levels. We are not far off. But look at the green line. The green line is the volume levels. We are at year-to-date highs for volume levels out of LA right now. And if that continues to hold, I wouldn't be surprised if tender rejections find a new year-to-date high out of LA. And that's really going to drive spot market rates up out of LA. So if you are moving freight out of LA and your shippers are asking you to cover more loads for them, you're going to want to need to increase the prices because carriers will ask for that premium. Keep an eye on that. And just to get a quick look here at the rates, so this chart right here will show us the rates. Before we get to those, just look at these gauges up here at the top. They show who has pricing power. The closer you are to 0, it's in the favor of the shipper. The closer you are to 100, the more pricing power the carrier has. The origin market, in this case, we're going from LA to Chicago. This is driving. We're sitting at 71 and 80. So very strong pricing power in the favor of the carrier, with your current rate today sitting at $1.37. Which is very high, and it looks like there might be some softening soon, so keep an eye. And that'll do it for today's broker update.
Welcome to your Rail Intermodal update. I'm here with Mike Baudendistel. Mike, what's the latest?
The latest is this morning the AAR, Association of American Railroads, just put out volumes for week 25. And so have those on the screen here. Talk about total carloads and intermodal containers or intermodal units as being two distinct markets because the economics of moving those are so different. And I think that's even more true today because the volume trends have been so different as well. On the left here in blue are total carload traffic. That's showing improvement from the bottom, still down about 20% year over year in the U.S., down about 22%. In the last week, still an improvement, was down at 1.30%. But you're seeing on the industrial side of the economy, the economically sensitive commodities that are moved by rail, like metals, down over 30%. So we've seen some improvement with things like auto plants coming back online. That was down 25%, a far cry from where that went almost to zero. So, but still on the carload side of the business, a lot of weakness in the industrial side of the economy. Closer to you on the right, we have total intermodal containers, and that's really been a different story. That's shown quite a lot of improvement. That was down about 4% in the last week 25. So that went from being down, call it 15% to being down more like 5%. So we really have two very different views of the economy. I think the rail traffic, even if you don't move or involved in the rails directly, it's good to look at the traffic to get a sense of the economy. And we have just two very different views. It seems like the industrial economy down about 20% year over year. The consumer economy down more like 5% year over year. Just spoke to president of Intermodal Company yesterday for our conference, our 3PL conference, and he was talking about intermodal containers being okay. We're past the bottom, but still not quite going to expect to get above 2019 levels, this year. So I still think it's going to be down a little bit, throughout the remainder of the year, which I thought was interesting. This next screen is intermodal train speeds, which you've seen sort of in general, the pattern. Each of these lines represents a different railroad. The west closer to me, the east closer to you, and in general, these have risen over the course of the last year as service has been strong. It's one indicator of service, maybe not the be all end all, but here, in the latest data points, we've actually seen a drop, off of the highs for all four of the Class 1 U.S. railroads, at least the biggest of the four, and that gets to the question of, is rail service going to be as strong if we really do see substantial improvement in volumes over the next year or two? I think that's something that's debatable, but starting to see some degradation in at least the train speeds, which I think it's critical to have that good service if you're going to be competitive with truck. On this next chart, show that comparison directly in blue, our long haul tender volume index, and in green, domestic loaded container shipments. So rail intermodal in green, truck in blue, and a portion that's competitive. And you really saw earlier in this year, truck outperform rail, particularly when there was the panic buying. Things were very time sensitive. But lately, closer to you on the right side of the screen, they've moved, pretty much in line as the truckload market has improved. Rail, has done more on the rail intermodal. It's become more in parity. You've just heard Luke Falasca talk about the strength in LA. That's been a big part of it as well.
Excellent, Mike. This is amazing stuff. Looking forward to having you on Freight Now to dive in a little bit more of these details. And thank you so much for today's segment. And thank you so much for tuning in. That's going to do for this Rail Intermodal update. The content doesn't stop here. We're always streaming around the clock. So check out our FreightWaves TV app on all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.